If you were 20 years old in 2020, that year quietly removed your chance to ever own a home. You didn't know it yet, but it happened. They printed $3 trillion. In 1 year, not over a decade, not gradually. $3.3 trillion flooded into existence in 2020 alone. That's 1/5 of every dollar in America. And nobody asked you. Here's what they told you. It was temporary, necessary, to save the economy from a pandemic that shut down the world. The Federal Reserve called it quantitative easing, a technical term designed to sound boring, controlled, safe. But here's what they didn't tell you. Once you create that much money, you can't take it back. You can't unprint it. You can't reverse the damage. Picture that person who was 20 in March 2020, just finished college, or about to. Maybe working their first real job. Maybe still looking. They had student loans, but payments were paused. No savings, but rent was manageable. They didn't own anything yet. They thought they had time. We'll come back to them. In March 2020, when the world locked down and the stock market crashed, the Federal Reserve made a decision. They slashed interest rates from 1% to 0.25%. Borrowing became the cheapest it had ever been in modern history. The logic was simple. If people and businesses could borrow money for almost nothing, they would spend it. Spending would keep the economy alive. Jobs would be saved. The crisis would pass. Which is what made the damage invisible. By April 20th, less than 30 days later, the Federal Reserve had already revised its money printing plans. They increased their order from 5.2 billion notes to 6.2 billion notes. A 19.7% increase. Total value, $185.7 billion in physical currency. But that was just paper money. The real flood happened digitally. 500 billion in Treasury securities purchased immediately. Then more. Then more. Month after month, the Federal Reserve kept buying, kept printing, kept expanding the money supply. This is the last moment where the system could have corrected. The federal government launched stimulus packages. Checks sent directly to households. Unemployment benefits expanded beyond anything the system had ever handled. Programs like Paycheck Protection handed out loans businesses didn't have to repay. In the United Kingdom, similar measures rolled out. The Eat Out to Help Out scheme alone cost £849 million. Furlough programs kept workers on payroll while businesses stayed closed. Every government on earth made the same choice: print money or collapse. They all chose to print. And for a while, it worked. Stock markets recovered. Unemployment dropped. Housing markets didn't crash. They exploded. Home prices surged as cheap borrowing and stimulus checks met limited inventory. People who already owned assets got richer. Those who didn't fell further behind. After this, there was no fixing it quietly. But that's not what broke the system. Nobody saw the inflation coming. That's the official story. It wasn't true. By 2021, prices started rising. First energy, then food, then everything else. Central bankers and economists called it transitory. A temporary spike caused by supply chain disruptions, by pandemic-related shortages, by the sudden reopening of frozen economies. They said it would pass. It didn't. By 2022, inflation wasn't transitory anymore. It was accelerating. This is where it turns. The European Central Bank admitted later that their models completely failed. Professional forecasters at every major institution got it wrong. Inflation turned out to be much higher and much more persistent than anyone projected. Here's why those models failed. Those $3 trillion didn't just sit in bank accounts. They moved through the economy like a flood. People spent their stimulus checks. Businesses took cheap loans and expanded. Investors poured money into stocks, real estate, cryptocurrencies, anything that might hold value. Demand exploded. Supply couldn't keep up. Factories had shut down during the pandemic. Shipping routes were clogged. Workers had left jobs and weren't coming back. The entire global production system had fractured. No amount of money could fix it overnight, so prices rose and kept rising. From here on, every option costs more than it gives. In developing economies, inflation hit double digits. In 2024, about a quarter of all developing countries saw annual inflation exceed 10%. Since January 2021, consumer prices in developing economies increased by 21.1%. Not over 10 years, in 3 years. For the poorest households, the impact was catastrophic. Food prices surged. Energy costs doubled or tripled in some regions. Wages didn't keep up. This is where it hits your life. If you were in your 20s in 2020, you entered the workforce during a pandemic. You took jobs at wages that seemed reasonable at the time. Maybe you got a stimulus check. Maybe you qualified for expanded unemployment benefits. But then, as the economy reopened, you watched your purchasing power evaporate. Rent increased. Groceries cost more. Gas prices spiked. Your car insurance went up. Your health insurance went up. Everything cost more, but your paycheck didn't grow fast enough to match. By 2025, income growth for most workers slowed to just 2% after inflation, the lowest increase in a decade. For workers aged 25 to 29, the impact was even worse. You're new to the workforce. You don't have years of raises built up. You don't have equity in a home that appreciated. You don't have a stock portfolio that grew during the boom. You just have debt, and that debt became more expensive. This decision guaranteed what came next. The Federal Reserve had a choice: keep interest rates low and let inflation destroy the value of money, or raise rates and choke off economic growth. They chose to raise rates fast. Starting in 2022, the Federal Reserve began hiking interest rates at a pace not seen in decades. The goal was to make borrowing expensive again, to slow down spending, to force inflation back down. It worked, but the cost was brutal. Higher interest rates meant higher mortgage rates, higher car loan rates, higher credit card rates, higher costs for everything financed with debt. This is the part they don't talk about. Total student loan debt in America reached $1.814 trillion by 2024. Federal student loan debt alone, $1.661 trillion. 42.5 million borrowers carry it. That's roughly 1 in 8 Americans. Remember that person who was 20 in 2020? By now they're 25. Their student loan payments resumed in 2023. Their balance, roughly $30,000, the federal average. During the pause, they tried to save. They put away $200 a month for 8 months, $1,600 total. They thought maybe they could start building a down payment fund. Then inflation hit. Rent went up 18%. Groceries cost 25% more. Their car insurance doubled. They spent the $1,600 they'd saved just covering the gap. When loan payments resumed, they faced not just their original debt, but an economy where everything cost more. Their paycheck grew by maybe 5% total across 3 years. The math stopped working. After this, the math never works again. By the end of 2025, borrowers had defaulted on over $92 billion in student debt. Nearly 9 million people nationwide met the legal definition of default. That's 9 million people whose credit is destroyed, who can't buy homes, who can't get car loans, who can't escape the cycle. And it gets worse. Because even if you manage to avoid default, even if you're making payments, you're still trapped. The housing market became completely unaffordable. In 2022, the median house price was 5.81 times the median household income. In 1984, it was 3.57. For millennials and Gen Z, the ratio is even worse, 5.6 home price to income. In 1960, it was 2.1. Your grandparents could buy a house for roughly twice their annual income. You need more than 5 times yours. The median home price in 2024, $407,500. If you're earning $40,000 to $45,000 per year, which is the average for Gen Z workers, you would need to save 20% of your income for 10 years just to afford a traditional 20% down payment. But you're not saving 20%. You're paying rent. You're paying student loans. You're paying for groceries that cost more than they did 2 years ago. This is where the trap closes completely. 52% of Gen Z non-homeowners have struggled to pay rent at some point. 60% of Gen Z fear they'll rent forever. And this fear changes everything. But that wasn't the real collapse. Researchers at the Federal Reserve discovered something disturbing. When people believe homeownership is impossible, they stop trying. They stop saving. They stop working toward financial goals. They spend money on short-term gratification instead of long-term security. It's not irresponsible. It's rational. If you're never going to own a home, why sacrifice now? If the traditional path to wealth is blocked, people find other paths, or they give up entirely. That person who was 20 in 2020, they're 26 now. They've done the math a dozen times. They've used every mortgage calculator. They've read every article about creative financing and down payment assistance programs. They tried to wait it out. They thought maybe prices would drop. Maybe interest rates would fall. Maybe their salary would catch up. It didn't happen. Even if they saved aggressively, even if they cut expenses to the bone, they'd need 8 to 10 years to save for a down payment. By then, they'd be 35. By then, prices might be even higher. Interest rates might be worse. So they stopped saving for the house. This wasn't laziness, it was math. They're still paying rent, still paying student loans. But now, they're spending what's left on things that feel good now, because the future they were promised doesn't exist. This behavior compounds over time. Children of parents who gave up on homeownership start with fewer resources. They're more likely to give up too. It becomes generational. Children of homeowners are far more likely to become homeowners themselves. Not because they're smarter or work harder, but because their parents can help with down payments. Because they inherit property. Because they grow up believing ownership is possible. The gap widens. This is the last moment where the system could have corrected. By 2025, Gen Z's homeownership rate hovered around 26%, largely unchanged from the prior year. Some Gen Z buyers managed to purchase during 2021 when interest rates were at historic lows. They locked in mortgages at 3% or less. But for everyone who didn't buy then, the door closed. Interest rates soared. Home prices kept rising. The combination made entry impossible. Now, even if prices stabilize, even if rates eventually drop, you're competing against people who already own property, who already built equity, who can leverage that equity to buy more. You're starting from zero in a game where everyone else is already ahead. When the Federal Reserve printed $3 trillion in 2020, it seemed like the right move. It prevented an immediate collapse. It kept businesses alive. It kept people employed, but it created a ticking bomb. That money had to go somewhere. It went into assets, stocks, real estate, commodities. The people who owned assets got richer. The people who didn't own assets got crushed by inflation. Years later, the consequences are locked in. Gen Z and younger millennials face a future where homeownership, the traditional foundation of middle-class wealth in America, is out of reach. Without home equity, you can't borrow against your property to start a business. You can't pass wealth to your children. You can't retire with the security of owning your shelter. You rent forever. Rent increases every year. You never pay off a mortgage. You never own anything. The wealth gap becomes permanent. That's not what broke the system. While inflation crushed purchasing power and interest rate hikes killed homeownership dreams, another crisis was building silently. The job market froze, not with mass layoffs, not with skyrocketing unemployment. Companies didn't fire people. They just stopped hiring. By 2025, hiring rates had flatlined. Companies replaced workers who left, but they didn't expand. They didn't create new positions. They didn't take risks on young talent. Why? Economic uncertainty made growth too risky. Tariff threats, geopolitical tensions, inflation fears, interest rate volatility. Business leaders didn't know what was coming next, so they played it safe. This is where it gets personal. They held on to existing workers. They froze salaries. They delayed promotions. This created a phenomenon called job hugging. Workers who might have switched jobs for higher pay stayed put, not because they loved their jobs, but because the alternative was too risky. If you're employed and the job market is frozen, you don't quit. You don't negotiate aggressively. You take what you're given. For employers, this was perfect. Staffing became stable. Turnover dropped. They didn't have to raise wages to retain talent. They didn't have to compete for workers. But for employees, especially young employees, it was devastating. The way you increase your income when you're young is by changing jobs. When you're 25, you don't have decades of raises built up. You don't have senior positions. You increase your salary by taking a better offer somewhere else. But if no one is hiring, you can't do that. From here on, every option costs more than it gives. That person who was 20 in 2020, they're 26 now. They've been at the same company for 3 years. Same position, same salary, with a 3% raise each year. Before inflation, that would have been fine. After inflation, it's a pay cut. They applied to 30 jobs in the past year. They updated their resume. They practiced for interviews. They networked. They tried everything they were told to do. 2 interviews. No offers. The market isn't moving. They're trapped. This is why your generation never recovered. By September 2025, the median income for employees aged 25 to 54 rose by only 5%, which translated to 2% after inflation. The slowest growth rate since the early 2010s, when unemployment from the Great Recession was still crushing the economy. For workers in their 20s, it was even worse. The earnings of workers aged 22 to 27 have barely improved since 1980. Meanwhile, earnings of workers aged 55 and older have grown by 35%. If you're in your 20s now, you're earning roughly the same in real terms as someone your age earned 40 years ago. But everything costs more. Housing costs more. Education costs more. Healthcare costs more. Your grandparents could afford college by working a summer job. You graduate with tens of thousands in debt. Your parents could buy a house in their 20s. You can't afford rent. The system that created this isn't broken. It's working exactly as designed. This is where it hits your generation hardest. While Gen Z and Millennials drown in debt and stagnant wages, the largest wealth transfer in human history is underway. Baby boomers and the silent generation will bequeath $84.4 trillion in assets through 2045. $72.6 trillion will go directly to heirs. Baby boomers alone, $53 trillion. The silent generation, $15.8 trillion. But here's the part they don't tell you. That money isn't distributed evenly. The top 10% of households by wealth receive 56% of all intergenerational transfers. The bottom 50% receive 8%. If your parents own a home, you'll probably inherit wealth. You'll probably own a home yourself. You'll probably be fine. If your parents don't own a home, you're starting from nothing and staying there. This is where the system divides permanently. Households with less than $500,000 in net worth will transfer about $3 trillion to their heirs. Households with more than 500,000 will transfer 4 times that much. The gap doesn't close, it widens. It compounds across generations. If you can't buy a home, you can't pass one to your kids. If you can't build equity, you can't help with their down payment. If you're crushed by debt, they inherit nothing. Your children start behind. Their children start further behind. Meanwhile, the children of homeowners inherit property. They use that property to buy more property. They leverage equity to invest. They compound wealth across decades. 2 Americas emerge. One where wealth transfers generationally and security is inherited. One where debt transfers generationally and struggle is inherited. This isn't speculation. It's already happening. Research shows that children of parents who gave up on homeownership are far more likely to give up themselves. Hopelessness breeds more hopelessness. Wealth breeds more wealth. Too big to fail wasn't discovered. It was designed. And that was just the beginning. The crisis wasn't limited to America. Same pattern. Different continent. Central banks printed money. Inflation followed. Interest rates surged. Young workers got crushed. In Europe, the inflation surge of 2021 and 2022 caught everyone off guard. The European Central Bank admitted their models missed it entirely. Energy shocks from the Russia-Ukraine war amplified the crisis. Gas prices exploded. Heating costs soared. Food prices spiked. This is the part nobody prepared for. In developing nations, the damage was catastrophic. By 2024, about a quarter of developing countries saw inflation exceed 10% annually. Since January 2021, consumer prices in developing economies increased by 21.1%. For households already living on the edge, this was devastating. Food became unaffordable. Protests erupted. Governments collapsed. Entire economies teetered. The United Nations warned that persistently high inflation set back progress in poverty eradication, especially in the least developed countries. After this, there was no fixing it quietly. Global growth slowed. The World Bank predicted growth would drop to 2.4% in 2024, before edging up to 2.7% in 2025. Geopolitical tensions made it worse. Conflicts in the Middle East threatened oil supplies. If the situation escalated, oil prices could spike by 30%. That would stoke global inflation and reduce global growth by 0.2 percentage points. The fragility was everywhere. Debt levels soared during the pandemic as governments borrowed to fund stimulus programs. Now, with interest rates high and growth slow, that debt became unsustainable. Developing countries faced impossible choices: service debt or fund basic services, pay creditors or feed citizens. Many chose default. The cycle repeated. High debt led to default. Default led to credit downgrades. Downgrades led to higher borrowing costs. Higher costs made debt even more unsustainable. The system that was supposed to save the economy during the pandemic created fragility that will take decades to unwind. If it can be unwound at all. That wasn't the real collapse. Here's the part that doesn't make the news. The reason inflation hit so hard wasn't just supply chain disruptions or energy shocks. It was behavior. During the pandemic, businesses and consumers changed how they responded to price signals. Normally, when costs rise, businesses absorb some of the increase to stay competitive. They squeeze margins. They optimize. They don't pass every cost increase directly to consumers. But after 2020, that changed. This is where the system reveals itself. Businesses realized they could raise prices without losing customers. Why? Because everyone else was raising prices too. There was no competitive pressure to hold the line. So prices went up fast, and once they went up, they didn't come back down. Even when supply chains recovered, even when energy prices stabilized, prices stayed high. Economists call this price stickiness. Once businesses and consumers accept a new price level, it becomes the baseline. You don't roll back a rent increase once tenants have adjusted their budgets. You don't lower grocery prices once customers have adapted. The inflation became permanent. The Federal Reserve's aggressive rate hikes didn't fix it. They just slowed the economy. This is where the trap completes. Credit contracted faster than expected. Lending rates rose faster than models predicted. Businesses stopped borrowing. Consumers stopped spending. The aggressive monetary policy response worked, but at enormous cost. Growth slowed, hiring froze, wages stagnated. The people who already owned assets were fine. Their homes appreciated. Their stock portfolios recovered. The people who didn't own assets were destroyed. This is the last moment where the system could have corrected. The system doesn't care about fairness. It doesn't care about opportunity. It doesn't care about your generation. It cares about stability. And stability, in the eyes of central banks and governments, means protecting the value of existing assets. Protecting banks. Protecting bondholders. Protecting creditors. Not protecting workers. Not protecting renters. Not protecting young people trying to build a future. The money printed in 2020 went to asset owners. The inflation that followed crushed wage earners. That wasn't an accident. It was the design. And this decision guaranteed what came next. We're at the turning point now. Not in 2020, when the money was printed. Not in 2022, when inflation exploded. No. The question isn't whether Gen Z and Millennials got screwed. They did. The question is whether the system corrects or whether the gap becomes generational. Here's the optimistic scenario. It requires political courage we haven't seen in 40 years. Interest rates stabilize. Housing supply increases. Wages catch up to inflation. The job market thaws. Home prices moderate. Affordability improves slightly. Student debt relief expands. The burden eases. Zoning laws change. Wage growth accelerates. The wealth gap stops widening. In this scenario, the crisis becomes a bad memory. Your generation survives. But that scenario depends on things that haven't happened yet, and probably won't. Now here's the realistic scenario. Housing prices don't drop. They stabilize, but at levels still unaffordable for most young workers. Interest rates stay elevated for years. The job market remains frozen. Student debt relief is limited and politically contentious. Millions remain in default. Credit scores stay damaged. Home ownership remains out of reach. This is the path we're already on. Wage growth stays sluggish. Inflation moderates, but prices don't roll back. Everything still costs more than it did 5 years ago. Your income hasn't kept pace. The wealth transfer from boomers accelerates inequality. The children of homeowners inherit property and security. The children of renters inherit nothing. Two economies solidify. One for people with intergenerational wealth. One for people without. In this scenario, the crisis doesn't end. It becomes the new normal. Your generation adapts. You rent forever. You delay families. You give up on traditional milestones. You find other ways to build meaning, community, experiences, digital ownership, alternative paths. But the wealth gap remains, and it passes to the next generation. Now here's the dark scenario, and this one feels inevitable. Another shock hits before the system recovers. Another pandemic, another financial crisis, another geopolitical collapse. Governments print more money because it's the only tool they have left. Inflation returns. Interest rates spike again. The cycle repeats, but worse. This is where the system breaks completely. Debt levels become unsustainable. Defaults cascade. Banks fail. Credit freezes. The economy contracts sharply. Young workers who barely survived the first crisis get hit again. This time, there's no stimulus check. No expanded unemployment, no safety net left. Homeownership becomes a relic of the past for anyone under 40. Renting becomes permanent, not just for Gen Z, but for their children. Wealth inequality explodes beyond anything modern democracies have seen. Social unrest follows. Political systems fracture. In this scenario, the crisis isn't just economic. It's civilizational. Which path are we on? Here's the final truth. The money printing worked. It prevented a collapse in 2020. It kept businesses alive. It kept people employed during lockdowns. It stabilized financial markets. But it had a cost. And that cost was paid by the people who didn't own assets when the money was printed. If you owned a home in 2020, it appreciated by 30 to 50% in most markets. You got richer without doing anything. If you owned stocks in 2020, the market doubled. You got richer without doing anything. If you owned bonds or commodities or real estate, you benefited from the flood of money. This is the mechanism they never explain. But if you were 20 years old in 2020, just starting out, with no assets, no home, no portfolio, you got nothing. You got inflation. You got stagnant wages. You got frozen job markets. You got unaffordable housing. You got debt. That person we've been following? They're 26 now. Still paying rent. Still paying student loans. Still working the same job at barely higher pay. They've given up on buying a house. They've accepted they'll probably never own property. They're not planning for retirement because the math doesn't work. They tried to save. They tried to switch jobs. They tried to wait it out. None of it worked. They're one emergency away from default. One medical bill, one car breakdown, one layoff. And they're not alone. Millions are in the exact same position. This is the generation that paid for the rescue. This is the generation that absorbed the cost of keeping the system stable. And nobody asked if this was fair. Nobody debated whether an entire generation should pay the price for rescuing the economy. It just happened. The system doesn't ask permission. The Federal Reserve doesn't vote on whether to print money based on how it will affect 20-year-olds versus 50-year-olds. They act, they stabilize, they protect the system. And the system rewards asset owners. Always. This isn't a conspiracy. It's not a deliberate attack on young people. It's just how the incentives work. Central banks exist to prevent collapse. They do that by flooding liquidity when crisis hits. That liquidity flows into assets. Asset owners benefit. Workers, renters, young people starting with nothing. They bear the cost. Every time. In 2008, the same thing happened. The financial crisis hit. The Federal Reserve bailed out banks. They printed money. They kept the system stable. Asset owners recovered. Home prices rebounded. Stock markets hit record highs. But young people entering the workforce in 2008 faced a brutal job market, stagnant wages, and a housing recovery that priced them out. Now it happened again. Bigger, faster, more extreme. $3 trillion in 1 year. And the people who were 20 in 2020 will spend the rest of their lives dealing with the consequences. Not because they did anything wrong. Not because they're lazy or entitled or financially irresponsible. Because the system is designed to protect assets, not people. And once you understand that, you understand everything. You understand why housing is unaffordable. You understand why wages don't keep up. You understand why student debt is crushing. You understand why the job market is frozen. You understand why the wealth gap keeps widening. The system works exactly as it's designed to work. It's not broken. It's just not designed for you. The next crisis is already being written. The debt is already too high. The fragility is already baked in. And when it hits, they'll make the same choice again. Print money. Protect assets. Let your generation pay the bill. That person who was 20 in 2020 will be 30-something when it happens. Still renting. Still in debt. Still starting from zero. and the cycle will repeat. Because that's what the system does. That's all it's ever done.